Taxes can often seem confusing and overwhelming, given the variety of tax types, regulations, and implications. Understanding how taxes work is crucial for financial planning, whether you're an individual, a business owner, or an investor. This guide will explain the fundamentals of taxes, including their types, how they are calculated, and strategies for managing and minimizing your tax liability. By the end, you'll be better equipped to navigate the world of taxes and make informed financial decisions. 1. What are taxes? Taxes are mandatory financial charges or levies imposed by governments on individuals, businesses, and other entities to generate revenue for public services and programs. They fund essential services such as healthcare, education, national defense, and infrastructure. The basics of taxation. 1. Taxpayer, the individual or entity obligated to pay taxes. 2. Tax base, the amount on which a tax is calculated, e.g., income, property value, or sales. 3. Tax rate, the percentage applied to the tax base to determine the amount owed. Taxes vary by jurisdiction and can be imposed at federal, state, or local levels. 2. Types of taxes. Income taxes are levied on wages, salaries, business income, and other earnings. In many countries, these taxes are progressive, meaning higher income levels are taxed at higher rates. 1. Individual income tax, paid by individuals on their personal earnings. 2. Corporate income tax, paid by businesses on their profits. Payroll taxes are deducted directly from employees' wages and fund social programs like Social Security and Medicare in the U.S. Employers also contribute an equal amount to these programs. Sales taxes are imposed on the sale of goods and services. They are usually a percentage of the purchase price and are paid by consumers at the point of sale. Property taxes are levied on the value of real estate or other property. They are often used to fund local services such as schools, police, and fire departments. Excise taxes are applied to specific goods, such as gasoline, alcohol, and tobacco. These are sometimes referred to as sin taxes, because they are often designed to discourage certain behaviors. Capital gains taxes are levied on the profit from the sale of investments or assets. These can be short-term or long-term, depending on how long the asset was held. Estate and inheritance taxes. These taxes apply to the transfer of wealth after someone's death. Estate taxes are levied on the deceased's estate, while inheritance taxes are paid by the beneficiaries. 3. How taxes are calculated. Taxable income is the portion of income subject to taxes after deductions and exemptions. It includes wages, interest, dividends, and other forms of earnings. Deductions and credits. 1. Deductions, reduce taxable income. 1. Examples include student loan interest, mortgage interest, and business expenses. 2. Credits, directly reduce the amount of tax owed. 2. Common credits include the Earned Income Tax Credit, EITC, and Child Tax Credit. Marginal and effective tax rates. 1. Marginal tax rate, the rate applied to the last dollar of taxable income. 2. Effective tax rate, the average rate of tax paid as a percentage of total income. Withholding. Employers often withhold taxes from employees' paychecks based on their income and tax filing status. This helps ensure taxes are paid throughout the year. 4. Importance of tax compliance. Tax compliance involves fulfilling your legal obligations to report income, calculate tax liability, and pay taxes owed. Failure to comply can result in penalties, interest, or legal action. Compliance also ensures access to tax benefits and avoids complications with tax authorities. Filing tax returns. Taxpayers must file annual tax returns to report income, claim deductions and credits, and calculate tax liability. In the US, the deadline for individual tax returns is typically April 15th. 5. Strategies for managing taxes. Plan ahead. Tax planning involves structuring your finances to minimize taxes owed. This includes timing income and deductions, maximizing tax-advantaged accounts, and investing strategically. Use tax-advantaged accounts. 1. 401k and IRA. Contributions to these retirement accounts are often tax-deductible, and earnings grow tax-deferred. 2. Health Savings Account, HSA, offers triple tax benefits: deductible contributions, tax-free growth, and tax-free withdrawals for qualified expenses. Maximize deductions and credits. Keep thorough records to ensure you claim all eligible deductions and credits, such as those for education expenses, charitable donations, or energy-efficient home improvements. Leverage capital gains tax rules. 1. Hold investments for more than 1 year to benefit from lower long-term capital gains tax rates. 2. Use tax loss harvesting to offset capital gains with losses from other investments. Work with a tax professional. A tax advisor or accountant can help navigate complex tax situations, identify savings opportunities, and ensure compliance with tax laws. 6. Common tax mistakes. To avoid filing late or not filing at all. Missing the tax filing deadline can result in penalties and interest. If you can't file on time, request an extension, but remember to pay any taxes owed. Incorrect information. Errors in your tax return, such as incorrect social security numbers or income figures, can lead to processing delays or audits. Missing deductions and credits. Overlooking available deductions and credits can result in paying more taxes than necessary. Poor record keeping. Maintain records of income, expenses, and financial transactions to substantiate your tax return and simplify the filing process. Overlooking state and local taxes. In addition to federal taxes, be aware of state and local tax obligations, as they can vary significantly by location. 7. Understanding tax reform and changes. Tax laws are subject to change due to new legislation or economic conditions. Stay informed about updates to ensure your tax planning strategies remain effective. Recent tax trends. 1. Changes in tax brackets or rates. 2. Adjustments to deductions and credits. 3. Updates to retirement account contribution limits. Consult reliable resources or tax professionals to stay up to date with the latest regulations. 8. Real-life example. Tax savings for an average family. Consider a family earning $75,000 annually. By taking advantage of deductions, such as mortgage interest and childcare expenses, and contributing to a tax-advantaged 401k, they can significantly reduce their taxable income and overall tax liability. Taxes are an inevitable part of life, but understanding their intricacies can empower you to make smarter financial decisions and save money. By learning the basics of taxation, leveraging available deductions and credits, and planning strategically, you can manage your tax liability effectively while staying compliant with the law. Whether you're preparing your annual tax return or planning for long-term financial goals, a proactive approach to taxes can lead to greater financial stability and peace of mind.